This is what a growth opportunity looks like. It happens to be Tesla. And what I'm showing you is that when a company grows, it goes through some stages. I've covered this in some previous videos, but I think it's really important for you to understand. When they see a growth opportunity, what they do is project out what that opportunity is going to present them. Then what they do is raise the money to make that opportunity happen, and that usually turns into hiring people. So here you can see that Tesla went from a employee count of 48,016 to 99,290 between the time of roughly 2020 and 2021. Then what they did was they saw income growth of 80 million to 6.25 billion. And then Wall Street woke up and said, hey, this Elon Musk has got something going. We need to get involved in it. And the stock took off. And you can see it went up 2,541% in that period of time, from $15.65 to $413.29. That's a growth opportunity. And what I need to emphasize to you is if you can look at their books, you can see this happening. You can see them adding to their employee force. You can see their income going up before this happens. Let's take a look at another one. This is another growth opportunity. This is NVIDIA. I'm sure you're familiar with it. They increased their workforce from 13,775 to 22,473, or a 63% increase back before the stock took off in 2023. Their income, again, if you check their books, you would see went from 2.88 or 2.8 billion to 10.0 billion, or a 253% increase before Wall Street recognized there's something going on at NVIDIA. And they then proceeded to go up 1,300%. So is that an anomaly? No, it happens on a regular basis. These are some of the big gainers of the past year. Vertiv, again, NVIDIA, Supermicro, Modine, Meta, Netflix. And you can see they all had the same things in common, and that was, in most parts, a growth in employees. So if you can see that happening, and then you tie it into also growth in revenues and growth in income, and then sometimes you'll even see it in growth in debt. Look at SMCI. Why did they grow their debt by 1,009%? Well, that was because they were building three new facilities to assemble the servers that were holding NVIDIA's GPUs, and they skyrocketed. So it's being telegraphed if you know where to look. And that's what I've figured out. Now, there's some opportunities that are happening now. And that's where we can take our past learnings and say, how can we apply them to what's happening today so we can predict the stocks of the future that are going to take off? I did a video the other day on Navitas, and this was the thumbnail. And what I want to show you is on Navitas, a chart that gives a projection of what's going to happen in the future with Navitas. And as you can see here, Navitas is a depressed stock. It is a company that I've explained a number of times that makes a different kind of wafer. Rather than using silicone, it uses a combination of gallium and nitrogen, and thus it reflects some of the heat. So what we see happening at Navitas is, as the semiconductor industry goes through a depression, as you aren't buying electric vehicles, you haven't bought a new phone, smartphone and you haven't adapted into AI yet. Navitas is investing in its future. It sees a growth opportunity. So over the last several months, it has increased its sales force from 230 to 314. Its revenues have grown from 37.9 million to 91.7 million, or a growth of 142%. Why hasn't Wall Street jumped in on this? Well, it's a $2.29 stock with not much of a market cap, so it isn't on their radar. But this is a company that has recognized a growth opportunity and is investing in it. So if we can recognize Navitas as a growth opportunity, as a stock that is selling currently for $2.39, and yet it'll probably go in between now and 2027 to somewhere around $16 a share. Again, how do I know this? I analyze these stocks. I look at what they are saying their revenue growth is going to be. I then equate that to their current value, their current enterprise value, based upon their revenue, and then I project what their enterprise value will be in the future. I do another analysis that says, based on their projected growth in earnings per share and their 5-year PE ratio, what will the price be at the end of 2026 and the start of 2027? And my analysis comes back and says somewhere just under $16 a share. Is that a good enough growth from $2.30, what it is today? I think it is, and it's confirmed to me that this is a growth opportunity. And if I want to magnify the growth of my portfolio, because I recognize that Amazon, Google, Microsoft, they have recognized a growth opportunity, artificial intelligence, and they have grown, between them, spent $1 trillion on GPUs. So that's another signal that there's a growth opportunity. So we want to own Google, Microsoft, Amazon, because they're going to grow. They've recognized the growth opportunity and they're investing in it. And they'll give us anywhere from a 30 to 35% return over the next 5 years. But if we want an extraordinary return, we're going to have to invest in stocks like Navitas. And I've got a number of others that I've used this same research analogy on, and I'm sharing with my tribe. I'm sorry, but the 14-day free trial is gone. But if you want to get in on this, you come to the not the platinum. This is not stock. This is not swing trading. But come to the gold. It's going to cost you, I think it's $19.99 a month. But this is what I'm going to share with you, and then I'm going to ask you. Let's go find some more together. Because I'm going to scrape the internet to say, you enter the ticker symbol, I'll give you all the numbers. And if you strike gold, we'll all go mine it. I'm Kerry Grinkmeyer. I'm a retired financial advisor. This is what I do. I just turned 80 years old, and this is what I enjoy doing for the rest of my life, however long that might be.